Hopefully you've been spending some time with other videos I've created. A study of financial accounting just naturally walks students through the balance sheet, from assets to liabilities to stockholders' equity. And as we talk about those various elements of the balance sheet, we find related income statement accounts and other concepts to explore. And right now we're going to spend some time talking about stockholders' equity. Now, when you think about a corporation is a separate legal entity, separate from other companies, separate from you, and separate from me. You and I are both separate legal entities, separate individuals, and a corporation is really no different, except, see, the corporation is a legal structure. It's an arrangement. It's an entity created because state laws allow us to create this corporation. And once a corporation is in place, it can do pretty much anything that a person can do. It can buy things, it can sell things, it can borrow money, it could loan money or other assets to another business. It can sue people in other businesses. It can be sued. It can enter into contracts. You see, a corporation, this separate legal entity, can do pretty much anything that an individual can do. Now, the corporation cannot go to jail, but, and I'm not a lawyer, but believe me, if the corporation does things that are egregious enough, the owners and managers certainly have the potential to be able to go to jail. So a corporation can do pretty much what an individual can do. There are plenty of advantages associated with the corporate structure, not the least of which is limited liability. In fact, arguably, I should have put that at the top of the list, because you see, the limited liability means this. And I'm not an attorney, and this is not legal advice. We're just simply conveying some of the major advantages and disadvantages of the corporate structure. Any nuances that involve law, those questions, those concepts should be explored with an attorney. But limited liability at its most general level basically means that if you are a corporate shareholder and there is limited liability, that your exposure is limited to your investment in the corporation. In other words, if there's a lawsuit, you might lose the $30,000 you invested to purchase the stock of the company, but you don't lose your family home, your 401k, your car, and the family pet. So that's like the number one advantage of having the corporate structure. Of course, there are other advantages. It may be easier to raise funds, raise capital. It certainly could be easier to transfer ownership versus, let's say, a partnership or a sole proprietorship. If you wanted to change ownership, that could be facilitated a little bit more easily. And a corporation has a perpetual life, in theory. You can probably think about businesses in your home community. I can think of one here. I'm recording this in a studio in downtown Grand Rapids, and this is the area that is the headquarters of Meyer Corporation. It's been around since, I believe, the 1940s, and certainly seems like it's been successful and will be successful. That's a perpetual business right there. The corporate structure will outlast the owners, right? Owners can pass away and the corporation survives. Now, these are all great things. What about some disadvantages? A lot of them have to do with hassle factor. There is a cost to organizing a corporation. You're going to spend some dollars with your attorney. He or she is going to help you draft an articles of incorporation, an operating agreement, probably some kind of a buy-sell agreement. You really want to involve an attorney if you decide to organize a corporation. And then there are just inherent legal formalities and income tax formalities that go along with being a corporation. This limited liability is not free. It comes at a cost, and there is a hassle factor. Okay? And there is the potential for double or triple taxation. What I'm talking about there, let's just talk about the double taxation. You see, when a corporation pays dividends to its owners, dividends are not a tax deduction for the corporation, but they are typically included in the taxable income of the recipient. Now, there's a lot of tax law that is nuanced, and the ultimate tax results depend upon facts and circumstances for your unique situation. But generally speaking, the dividends are not deductible for the corporation when it pays them, and they typically are includable in the taxable income for the recipient. And that's where double taxation comes into play, because the corporation does not get a deduction for those dollars, but the recipient includes the income and has to pay tax on that income. Now, that is if the corporation is a traditional C corporation under subchapter C of the Internal Revenue Code. There is potential relief available if you are taxed under subchapter S of the Internal Revenue Code, known as an S corporation. Just know that that exists. That's an option, and that's a federal tax election, and it's definitely a topic for deeper discussion at a later date. There are plenty of advantages to being a corporate shareholder. Voting rights is one prime example. Now, we can talk about some differences that exist between common shares and preferred shares, or between different classes of stock, Class A shares versus Class B shares. But as generally conceived, shareholders do have the right to vote on major issues involving the corporation. Usually, the more shares you own, the greater the number of votes that you have available. Different classes of shares can change that. That's a discussion for a later date, but you do get voting rights. That's a typical right. Another wonderful privilege is the potential to receive dividends. Dividends are distributions of the corporation's earnings. When a corporation generates a net income, sometimes called earnings, then the board of directors may choose to declare a dividend of some of those profits. Now, that's very key, because the board of directors has to declare the dividend. If the board never declares the dividend, then the dividend will not occur. There also has to be sufficient retained earnings, and if it's a cash dividend, you have to have enough cash to be able to pay the dividend. But this is a potential right here, okay, that goes along. It's not a guarantee, but it is a privilege. Residual claims. If the corporation were to ever liquidate, and we can look at it this way. Think about the accounting equation. You may not have thought about it for a while. Assets equal liabilities plus stockholders' equity. Well, we can certainly rearrange this equation. Assets minus liabilities equals stockholders' equity. And think about what I'm suggesting here. If you take every asset of the corporation, think about buildings, equipment, accounts receivable, every asset, and those that can be turned into cash, you turn them into cash. So liquidate all the assets. Then use all of that cash. Got a big pile of cash. Use all that cash to pay off all the liabilities. Guess what happens? The cash that's left over would belong to the owners. That is a residual claim. Assets minus liabilities. Residual is kind of a residue. What's left over? Well, what's left over in this scenario would belong to the owners, and the owners would have a claim to those net assets. Not unlike having a claim to dividends. If the board of directors declared a dividend, owners could receive a share of what's left over after liquidation. There's also this right called preemptive right. What that basically means is that if you are an existing shareholder and there are potential new shares being issued, new shareholders coming in, you may or may not have the right to purchase some additional shares to preserve your ownership interest, maybe your percentage interest. This is a potential feature that could be associated with your shares. It's not a guarantee, it's just one option. While we can certainly make the presentation of stockholders' equity more complicated than what you see here, these are fundamental components. And at a minimum, what you're going to see is some element of contributed capital. And what we're talking about with contributed capital, think about the words there. It's capital that the owners have contributed to the corporation. This is really the landing place for the owner's investment. This is the realm of accounts like, really accounts you've seen already. Common stock would be considered contributed capital. Another option is preferred stock. Okay. These are just classes of stock, but they both are funds or other assets that owners have contributed. You might also see something called additional paid-in capital, sometimes called paid-in capital in excess of par value or something like that. And that's still owner's investment. The reality is that common stock and preferred stock, if there is a par value associated with that stock, these accounts are going to be populated with the par value of the stock. Any dollars paid in excess of par value will get recorded in additional paid-in capital, which is simply just another contributed capital account. You've also spent some time, I'm sure, at this stage of the game talking about retained earnings. Now, retained earnings is simply the accumulated profits of the company that have not been distributed to the owners in the form of dividends. Think about the word itself. It's earnings that have been retained. This is the concept of retained earnings. Earnings is synonymous with net income. So if we're able to generate a profit, that is earnings. Okay? Revenue is greater than expenses. And if the company does not declare a dividend, those earnings, that profit, will be retained by the company. And retained earnings gets bigger. It grows like a snowball. Now, of course, a company could generate a net loss for a particular period, in which case expenses are bigger than revenues. A net loss will cause retained earnings to get smaller. Hopefully not so much smaller that it changes names, but it can happen. Sometimes retained earnings gets called accumulated deficit. If we have a period where our net losses have exceeded our net income, it is possible for the corporation to dig this hole and have negative owner's equity. But let's stay positive here. Let's try to be optimists. And we'll say that retained earnings is increased by net income. Now, if we do pay a dividend, that dividend is going to reduce the retained earnings because dividends represent earnings that have been distributed to the owners, hence not retained by the corporation. Then we have this weird animal called treasury stock. I think of this as corporate cannibalism. It's basically a company buying back its own shares. That's a weird concept right there, okay? And we're going to talk about a few detailed transactions later in this discussion, but this is actually a contra account, a negative owner's equity account. So whereas most of the time owner's equity accounts are credit balance accounts, each of these would be credit balance accounts. Positive retained earnings would be a credit balance account. Treasury stock is a debit balance account. It is negative owner's equity. It's a contra account. And then we have this accumulated other comprehensive income. Now, other comprehensive income is a measure of a company's profitability that surpasses ordinary net income. Comprehensive income can arise from a few transactions such as foreign currency translation, unrealized gains or losses associated with investments. In other words, the value of investments has either increased or decreased, but we have not actually sold the investment. And there are some other things that affect comprehensive income, but they do not flow through regular net income. In other words, they don't flow through regular retained earnings. So you can think about accumulated other comprehensive income as being the retained earnings equivalent of other comprehensive income. So if other comprehensive income is an extension of net income, accumulated other comprehensive income is an extension of retained earnings. This is essentially the comprehensive income version of retained earnings, which is a complicated concept and may be beyond the scope for many people watching this particular discussion. At this stage of the game, I think you're going to be in good shape if you understand contributed capital, retained earnings, and a little bit on the treasury stock. When we form a corporation, the Articles of Incorporation is going to specify the number of shares that are authorized. In other words, this is the maximum number of shares that could be issued. Now, it's completely possible to have the number of authorized shares be equal to the number of issued shares. In other words, we chose to issue all of the shares that are authorized. And it's also possible to have this be equal to the number of shares that are outstanding. All right, a little more on that in just a minute here. So we have authorized, issued, and outstanding. However, these could be very different numbers. Let's just come up with a hypothetical example. Let's say that we have 100,000 shares authorized. In other words, this is the most number of shares that the company could issue. Shares of common stock, for example. Let's say that the company, at its formation, issued 50,000 shares. So half of the potential shares have been issued, but there's only 40,000 shares outstanding. And I'm going to run out of, I can't go in the triangle for this, but you'll get the point. Only 40,000 shares outstanding. Well, why would there be a difference between the number of shares issued and the number of shares outstanding? Outstanding means issued and in the hands of shareholders, of individual owners, not treasury stock. So what has happened at some point, most likely in this scenario, is that the company was formed, the maximum number of shares was 100,000 shares. The company issued 50,000 shares. Then at some point later, the company repurchased 10,000 shares as treasury stock. So those treasury shares have been issued, they're part of this 50,000, but they're not outstanding. In other words, they're not in the hands of the shareholders. The company itself owns those shares. So what you're seeing here is that the number of outstanding shares could not be more than the number of shares issued. And the number of shares issued could not be more than the number authorized. The numbers could be equal. It's possible to authorize 100,000, issue 100,000, and have all 100,000 shares outstanding. That certainly is possible. But if there is going to be a difference, or if there will be differences among these categories, it would have to go bigger to smaller in this particular order. And you see, this disclosure is very important. Think about this. What if you are a shareholder who owns some of these issued shares, some of these outstanding shares? Do you care that there might be more shareholders invited to the party? If there's only one pizza at the party and more people show up, you're not going to get a piece that's as big as you otherwise would have received. I can prove that to you. There are 12,859 shares outstanding for the preferred stock. The par value is $100 for each share. And if you do the math on this, you will very quickly see that the total par value is $1,285,900, which is exactly what you see over here for the preferred stock par value current and prior year. Now, it's possible that some of those shares were issued at a price greater than $100 per share. And if that were the case, it would be in this additional paid-in capital. Now, interestingly enough, this particular balance sheet, they chose not to disclose additional paid-in capital associated with preferred and or common stock. And arguably, maybe they should have done that. But what we're seeing here is that any amounts paid in excess of par value would be in this additional paid-in capital account. You see, take a look at the common stock as well. 20,000 shares authorized for this class of stock, only 6,600 issued and outstanding. And we're seeing the same thing with the total par value. For the common shares, you have 6,600 shares issued and outstanding, and the par value or stated value is $10 per share. That's $66,000, which explains the $66,000 that you see here and here. And so what you're seeing when you look at these comparative balance sheets, there have been no new issuances of common or preferred stock. There also have been no repurchases, no redemptions of common or preferred stock. And the reason I can tell you that is just by looking at the preferred stock par account did not change from year to year. The common stock account did not change from year to year, nor did the additional paid-in capital. So the only thing changing in the stockholders' equity section of this particular company's balance sheet, at least for the 2 years shown right here, is the retained earnings. Retained earnings has grown from 1.94 million to a little over 2.7 million. We're going to have some more detail on that in a few minutes, but I just want to round out our discussion with a couple other concluding concepts as we look at this excerpt. Par value is not market value. Okay? Book value is not market value. Par value is an arbitrary legal amount per share. It's nowhere near market value in most cases. It certainly can play a role, for example, in calculating the dividend associated with the preferred stock. But many companies are allowed under state law to issue stock without par value, in which case you simply just populate the account with whatever the owners have contributed. And then even if it is par value or book value, it's not market value. Market value is a different animal. Market value is what the current value of the stock would be. And it's really representative of what is the current market value of the company. So do understand that market value is different than book value, and book value is different than par value. This is an excerpt from a company's balance sheet, the shareholders' equity section of the balance sheet. And what you can see, this is the end of the current year, and this is the end of the previous fiscal year. Okay? And you can see, I just want to talk about some observations here. They have two classes of stock. They have preferred stock and they have common stock. Now, we would have to consult the disclosure notes to these financial statements to really understand the differences associated with these two classes of stock. But most likely, the common shareholders get to vote and the preferred shareholders don't get to vote. That would be one of the most likely differences between common and preferred stock. Now, before you get too upset and you say, well, that's not fair, we have the right of suffrage in this country, you should know that preferred shareholders also typically get to stand in the fast pass line for dividends. In other words, if dividends are going to be paid, preferred shareholders are typically in line before common shareholders. So preferred shareholders often give up voting rights, but they get preferential dividend and or liquidation rights. Okay? Those are just two potential differences between the common and the preferred shares. We can see that there are 25,000 preferred shares authorized, but just over half of those have been issued, 12,859. You can see that the preferred stock account is populated at a par value of $100 per share. Sure is difficult to discuss accounting without having a few journal entries, and that's what I want to do here. Now, what I've given you is, this is an excerpt from an actual Articles of Incorporation for a real corporation. And you can see that the total authorized capital stock in this case, no preferred shares, but there are 50,000 common shares authorized. And the par value per share is $1. Now, I can't tell you what this actual business is. It is a business in my local community, and I can guarantee you that this business is worth more than $1 per share. But that's the par value right there. Remember, par value is different than market value. Market value of this business is greater than $1 per share. And I actually haven't seen the company's balance sheet, but my guess is that the book value is greater than $1 per share as well. Okay? So let's assume, though, that we have this par value. How are we going to issue, let's say, 10,000 shares? So we have 10,000 shares issued, which is okay because there are 50,000 shares authorized, and we're going to issue these at $5 per share, which arguably would be market value at the time of issuance. So even though the arbitrary legal capital, the par value is $1 per share, we would assume that an incoming shareholder is going to pay a reasonable arm's length amount for each share of stock, as long as it's an open and willing transaction. So at formation, or at least at the time that this stock is issued, there's a pretty strong argument that the market value is $5 for each share. Now that, of course, will change over time. Could go up if the business is successful, could go down if the business is not operated well. But initially, this shareholder was willing to invest $5 per share. What's the journal entry going to look like? Well, let's start with the easy part. We're going to debit cash for $50,000 because the reality is we are receiving $50,000 from the shareholder. Now, when there is par value associated with the shares, then the common stock or the preferred stock account, in this case the common stock account, will be populated with the dollars at par value. So in other words, right here, common stock, and I'm going to abbreviate it as CS, we're going to credit the common stock account for $10,000. And that's simply a bookkeeping convention where we are reporting the par value associated with this common stock. Now, we know a couple of things. We know that even though the common stock par value is only this $10,000, we know that the shareholder invested $50,000. We also know that journal entries are supposed to balance. And right now, our debits do not equal our credits. That's where this additional paid in capital comes into account. And I'm going to just abbreviate that, but sometimes called paid in capital in excess of par. But it really is the extra $40,000. So what we have here is this. The shareholder has invested $5 per share, or $50,000 for 10 shares. 10,000 of those dollars are going to be recorded in the owner's equity account called common stock. The additional 40,000 that is in excess or above par is going to be recorded in the additional paid-in capital account. And we're done. Now, I had indicated that there are plenty of states that allow no par stock to be issued. What if that were the case? What if over here the par value is 0? Okay, or none, as it says right there. How is that going to change? Well, it actually simplifies things nicely. If that were the case, we would simply debit cash, credit common stock, and the additional paid-in capital becomes irrelevant. So remember, just a few minutes ago, we suggested that even though there are 50,000 shares authorized, perhaps this company issues 10,000 shares and the issuance price is $5 per share. Okay, so that means that total contributed capital is $50,000 in this case. Now, what would happen if this company repurchases 2,000 of its own shares? So think about this for a minute. So let's pretend that you and I and a few friends, we are the investors for this 10,000. The company issues the shares, and I bring some money to the table, and you bring some money to the table, and a few of your friends also bring some money. And collectively, the company issues 10,000 shares to us, and we give $50,000 to the company. Now, a few years down the road, let's say that the company wants to buy back some of those shares. So let's just say that 2,000 of those shares were mine. And the company comes to me and it says, we want to buy your shares back. This is why I call it corporate cannibalism, because after this transaction is done, I will no longer own those shares. The company will own shares of itself. So let's assume that the company wants to buy back 2,000 shares and they pay $6 per share. Okay? So I've made a little profit, certainly. They're going to pay $12,000 for this. How do we record this transaction? Well, initially, it's going to look like this. And really, there are two entries we're going to have here. Remember I suggested that Treasury stock is a contra owner's equity, or a negative owner's equity. Well, it is true. I mean, Treasury stock is a reduction of owner's equity. So if this company buys back my shares at $6 per share, 2,000 shares, then what's going to happen is we're going to make a credit entry to cash to cause it to go down because the company is paying money to the shareholder. And then we're going to make a debit entry to Treasury stock. That is going to be the reduction of owner's equity. And at this point, after this transaction has been completed, the company owns 2,000 shares of itself. Corporate cannibalism. What an odd concept. Now, let me go to an even odder potential concept. Let's say that now down the road again, okay, at some point, company says we're going to reissue some of these shares. So those shares that we bought back up here for $6 a share, let's reissue some of those in the hands of the investing public once again. Now, if you look at this, the savvy among you are saying, hey, they made a profit, right? Bought back their own stock at $6 per share later on, reissued it, and now the issuance price was $7 per share. That's $1,000 profit. We do not allow the company to record that gain or loss associated with the reissuance of Treasury stock on its income statement. So what this is going to look like when we get to that transaction is certainly the company will receive $7,000 because the new shareholder or shareholders are investing this. We need the Treasury stock to go away. And the reason this $6,000 is basically, okay, we've reissued 1,000 shares, and we had originally acquired those shares at $6. So what we're doing here is we're gonna get rid of that Treasury stock at the rate of $6. That's your 6,000 bucks right there. And then there's this little nuance of profit, which is not going to go through our income statement, but will become additional paid-in capital. So by redeeming stock at $6 a share and subsequently reissuing half of it at an extra $1 per share, owner's equity will get bigger, but not because net income is larger. It's a direct injection to contributed capital in the additional paid-in capital account. Let's explore some of the transactions associated with the payment of dividends. Now, shareholders will love to receive dividends, but remember, dividends are not guaranteed. They need to be declared by the board of directors. There has to be sufficient retained earnings. If it's a cash dividend, you have to have the cash to be able to pay the dividend. We're going to talk about a few instances where maybe a dividend is paid with something other than cash. For example, it could be paid with property or even with additional shares of stock. But if you want to pay a cash dividend, you've got to have the cash available. Some important dates associated with dividends. Declaration date. At the declaration date, this is when retained earnings will be reduced, and there's a liability that goes up. So in other words, when the board declares the when the board declares the dividend, retained earnings goes down and a liability increases in the balance sheet. Okay. Now the dividend is only going to be paid to shareholders who are owners as of a date of record. So there is this magical date where if you are an owner on this date, you receive the dividend. And if you're not, you're going to have to wait until maybe the board of directors declares one later on. Now, the payment date is different than the declaration date. This is going to happen first, and then later on, it takes a little time to organize the actual payments and get those distributed. So the payment date is often a later date. I suppose for closely held companies, for small businesses, family businesses, the declaration date and the payment date could be exactly the same. But for publicly traded companies, for large businesses, it's going to be declaration first, payment later on. And then, of course, at fiscal year end, we can't escape some accounting. What's going to happen is the dividends account is going to get closed to retained earnings at the fiscal year end. Let's assume, remember that company that we were looking at that had 10,000 shares issued? 10,000 shares issued and outstanding. Let's say that on October 30, they declare a dividend of 50 cents per share. And a lot of times dividends will be expressed on a per share basis. Doesn't have to be, but in this case, let's say they do that. So what does that mean? That means that the total dividend is $5,000. So on October 30, this is what we're going to have to record, because that's the date of the declaration. What we're going to see is that we're going to record dividends is going to be a $5,000 debit, and this dividends, this is part of shareholders' equity, okay? It's a contra account. So in other words, it's reducing shareholders' equity. And then we have a current liability, dividends payable, is going to increase by $5,000. Okay, that's a current liability on the balance sheet. So what we're seeing, and some companies may choose to directly reduce retained earnings. I suppose there wouldn't be anything technically wrong with that, because ultimately that is what's going to happen. What we're going to see in a few minutes is we're going to see that this dividend account is going to get closed, zeroed out to retained earnings. So that's where we're headed. And for some companies, if they want to go directly to retained earnings, don't pass go, don't collect $200 along the way, that's perfectly fine. But I'm going to keep it in this separate dividends account because we want to track that detail. So what we're seeing is on the date of declaration, this is exactly what happens, is that the entry that affects owner's equity is made and a corresponding liability is increased. Now later on, let's say a few days later, we actually make the payment to the shareholders. What's going to happen at that point, and I'll put this over here. Okay, so a few days later, we actually make the payment. What's going to happen is the cash gets distributed to the owners and the current liability goes away. So let's start with the easy part of the journal entry. It's going to be a credit to cash because we know that we're paying $5,000 to the owners. Okay, that's the essence of a dividend. The owners get that money. What's going to happen is this liability, this ultra current liability called dividends payable, that goes away. Because we established that dividend payable liability just before Halloween. That's a treat, not a trick. And a few days later, the real treat comes when the owners receive the cash and the liability goes away. Now we have one more thing we have to deal with, and that's the fact that this dividends account still has a $5,000 debit balance. Let's take a look at what we have to do with that at fiscal year end. See, at fiscal year end, unless we do something, that dividends account still has a debit balance, right? If we had a T account going for dividends, what we would see is, remember when the board of directors declared that dividend, we had debited dividends by the amount of $5,000. We have not done anything to change that account since it was born. So we need to zero out this account. And how do we do that? Well, if you have a $5,000 debit balance in an account, the only way I can think of to make that balance become zero is to make a credit entry to that account. And so that's exactly what we're going to do at fiscal year end. Let's assume that the year end is New Year's Eve. So what we do here is we're going to have this dividends account, and we are going to make a $5,000 credit to it. And ultimately, that is going to reduce our retained earnings account. Because you guys know that dividends reduce retained earnings. I've been telling you that for a long time. I don't know how many of my videos you've watched, but you've heard me say that more than once, I'm sure. And here I am proving it to you. Because you see, when the board of directors declared the dividend, they recorded it in this dividend account initially. And they parked it there. And then they created a current liability. And a few days later, they paid the dividend. The current liability went away. The cash is gone. Then ultimately, this dividends account needs to be reset to a big fat goose egg, zero, so that we can start to track this dividend activity for the next year. And how did we do that? We did it by zeroing out the account with a credit balance and ultimately reducing our retained earnings with a debit balance. You make a debit entry to an owner's equity account, it will go down. And you are seeing here in action the reality that dividends cause retained earnings to decrease. Remember our corporation that had 10,000 shares issued. let's pretend that this company issues a dividend, okay? And so we have 10,000 shares issued and outstanding. And let's just assume that the company pays a dividend of $1 per share, all right? So board of directors declares this. And yes, it's a bit of a coincidence that this dividend is the same as the par value. I am doing that with a purpose, but please understand that this dollar per share is par value. This dollar per share is the declaration of a dividend. And even though the numbers are the same, they represent different things. So in other words, the total dividend is going to be $10,000. Well, let's just take the shortcut to the dividend, what this is going to do to the financial statements. At the end of the day, look what happens here, is that the shareholders will receive $10,000 in cash, and ultimately that will reduce retained earnings. Yes, I did skip the step involving the dividend account. I also skipped the step involving dividends payable because I don't want to muddy the waters. At the end of the day, this is the ultimate impact of a dividend payment. Cash goes down because it goes into the hands of the shareholders, and retained earnings also decreases because we're distributing some of those earnings. Now, where I want to go with this is, what if, right after this dividend, what if the shareholders elected to reinvest the $10,000? Well, it would look just like this, right? If it were common stock. So look what's happening here, okay? Company, in fact, here, let me just put a date with it. It's like, okay, October 30, we have a dividend, and then October 31, trick or treat. Okay, shareholders decide to reinvest. So company makes a distribution, and the shareholders receive the cash, and then a day later, the shareholders decide to take this newfound cash and purchase additional shares of stock. Okay, could happen, right? Now, what if we did this? What if this happened? Let's say we just skip the cash step. Okay, skip the checkbook. Leave your checkbook at home. All we're going to have is this. Retained earnings goes down because there is a dividend, but then common stock increases. That is the nature of a stock dividend, right? Okay, the company says, we would love to issue a dividend to you, but we can't afford to, right? So we're going to give you more shares of a company that can't even afford to pay you a dividend. Now, I'm being facetious there. There are plenty of valid reasons for a company to issue stock dividends, right? Maybe they don't want to use cash, but they want to give ownership shares as an incentive compensation tool, for example. That's just one example of many where a stock dividend could be appropriate, okay? It definitely allows us to have increased ownership without sacrificing the cash position of the company. Cash is king, and if it's a growth-oriented company, cash may have a better purpose than being used as dividends. So just take away this. The cash dividend would be pay the cash, and then later on, maybe the shareholders reinvest. With a stock dividend, what you're basically saying is we skip the checkbook step, additional shares get issued, and the retained earnings goes down by a corresponding amount. There's another phenomenon we could encounter called a stock split. We just looked at stock dividends. And stock dividends, when those happen, there is a journal entry that needs to happen, right? We need to adjust the company's books and records because with a stock dividend, we're issuing more shares, so the common stock account will increase, and we are issuing a dividend, so the retained earnings will ultimately decrease. But with a stock split, that's a different animal. Let's assume that we have our company here. This circle is our entire company, and there are 10,000 shares issued and outstanding, and the par value is $1 per share. So your total common stock par value for this entire company is $10,000. Now, what if we were to conduct a 2-for-1 stock split? What that means is for every existing share, we're going to create another share. And after the stock split, there will be 2 common shares for every share that used to exist. So after a 2-for-1 stock split, this is what things are going to look like. They're going to be 20,000 shares. So there are more shares, but it's not a bigger company. It's not a bigger pie. It's still the same circle with the same area, the same circumference, same diameter. Okay. If you want to think about this as a pizza, or right now it's October 16, I'm thinking about pumpkin pie. If you want to think about it that way, that's fine. But the company has not changed. It's not worth more. It's not worth less as a result of this one transaction, this one event called a stock split. And as a reminder, we're not going to record this in our books and records. And the reason for that is because it's not a recordable event. Nothing is happening to the common stock account. Nothing is happening to retained earnings. Certainly, there will be some disclosure changes. For example, the balance sheet may now disclose there are 20,000 shares issued and outstanding, and the par value is 50 cents per share. Whereas we used to say 10,000 shares issued and outstanding, and the par value was $1 per share. But you see, the total amount of common stock on the balance sheet will remain unchanged. $10,000 after the stock split, $10,000 before the stock split. That's because it's the same company. After the stock split, there are more shares. They're just smaller. They have a smaller par value. They have a smaller market value as well. But this is nothing that needs to be recorded on the company's books and records. It's not unlike having a pizza. If you have a pizza cut into 4 slices, then you're going to have 4 slices of, equal 1/4 of a pizza each. If you decide to cut it into smaller pieces, then you certainly could feed more people, but each person's going to get a smaller slice of pizza, right? Same kind of thought here. So stock splits can affect the number of shares issued and outstanding, can affect the disclosure of your par value, can definitely affect the market value, but do not need to be recorded with journal entries. Our discussion of stockholders' equity would be incomplete without some look at the statement of shareholders' equity or statement of stockholders' equity. At its core, here's what's happening, is that the statement of shareholders' equity, and by the way, before I get too much farther, I mean, it could be a statement of stockholders' equity. Sometimes it's called the statement of changes in shareholders' equity or statement of changes in stockholders' equity. If this were a limited liability company, it would be called a statement of members' equity because the owners of an LLC are called members. If it were a partnership, it would be like statement of partners' capital, for example. So the title of this statement will be customized to the type of entity. But what I want you to focus on is, at its core, what is this statement conveying? What information is it giving you? And what you can see is you've got the major categories of stockholders' equity for a company's balance sheet. Preferred stock, common stock, additional paid-in capital, and then retained earnings. And what this statement is doing is it's basically saying, all right, at the beginning of 2016, which by the way is the same as if you looked at our 2015 balance sheet, you would see that preferred stock, common stock, additional paid-in capital, and retained earnings had each of these balances right here. So what we're doing is we're basically saying, hey, could you explain how these common stock accounts, these stockholders' equity accounts, changed from the balances they were at the end of 2015 to the balances that they were at the end of 2016? And we absolutely can. We can say, sure, retained earnings was $1.86 million. And then we generated a profit of $143,000 and some change for the 2016 fiscal year. We paid some dividends as well. And that actually caused our retained earnings to increase slightly to an ending balance of $1.939 million and some change, okay? Preferred stock, common stock, additional paid-in capital, no changes to those accounts. And then we have the other question. It's like, okay, let's go forward another year. So fast forward to the end of 2017. Could you explain why preferred stock, common stock, additional paid-in capital, and retained earnings are these balances that they are at the end of the year? And we absolutely can, because we can start with the beginning of 2017 is the $1,939,000 and some change. And then For the year 2017, so this would have been, this is coming from the 2017 income statement, maybe the 2017 statement of cash flows would give us some information about dividends. But during 2017, this is what's happening. We generated a profit, $846,000. We paid some dividends of $64,000. And that explains how retained earnings went from $1,939,000 at the beginning of the year to $2,721,000 at the end of the year. And the beautiful thing is this: if you were to look at the balance sheets for at the end of 2015, at the end of 2016, at the end of 2017, these are the balances you would see on those specific financial statements. You see, the statement of shareholders' equity is supplementing the balance sheet. It's explaining how these accounts arrived at those balances. What are some of the key factors that are influencing those balances? It's lending transparency. And what we're seeing is it's helping the financial statements to get along, because you see, the financial statements, they work together as one big happy family to tell us the story that we need to evaluate the health of a particular entity.